The day everything broke at once, stagflation, oil at $90, and the silver squeeze no one is talking about. Three things landed on the same day. Each one, on its own, would have been enough to move markets and dominate financial headlines for a week. Together, they are telling you something the mainstream financial media is not ready to say out loud. The U.S. economy lost 92,000 jobs in February. Brent crude broke $90 for the first time in 2 years, and silver vaults in Shanghai are now 15 days from empty. These are not three separate stories. They are one story. And when you see how they connect, the jobs data, the oil market, the war, the physical silver drain, and what India just did to the global pricing system, the picture that emerges is not a short-term disruption. It is a structural break in the financial architecture that has governed markets for decades. Before going further, check the handle. OG John Ag. Same on YouTube. Same on X. Copycats are everywhere in this space. Verify before you trust. And to be direct, no courses, no signals, nothing for sale here. Everything is free. Because the goal is not for you to rely on anyone to tell you what is happening. The goal is for you to see it yourself. Now, let's get into it. Section 1. The jobs report, stagflation is here. Friday, February's non-farm payroll report was released at 8:30 a.m., and within minutes every major market index turned red. The U.S. economy lost 92,000 jobs in February. The expectation was a gain of 58,000. That is not a miss. That is a completely different direction. Wall Street analysts, economists, and Fed officials had all built their models around a labor market that was cooling but stable. The February print did not confirm that narrative. It shattered it. A market expecting to gain 58,000 jobs instead lost 92,000. The gap between expectation and reality is 150,000 jobs. That does not happen in a soft landing. Unemployment climbed to 4.4%, above the 4.3% estimate. Another step in the wrong direction. But here is where the report gets significantly more important than the headline numbers suggest. And this is the part most coverage buried or skipped entirely. Average hourly earnings still rose 4%. Read that again. Jobs are being cut, unemployment is rising, and wages are still climbing at 4% annually. Jobs are disappearing, and wages are sticky. That combination has a name that the Federal Reserve and the White House have been carefully avoiding for the past year. Those two things happening at the same time have a name. It is not a soft landing. It is stagflation. Stagflation is not simply a recession. A recession is painful, but it is manageable. Central banks have a playbook for it: cut rates, stimulate borrowing, wait for recovery. Stagflation removes that option entirely. When inflation is still running hot while the economy is simultaneously shedding jobs, every tool the Fed has works against itself. The Fed cannot cut without feeding inflation. It cannot hold without accelerating job losses. That is a trap with no clean exit. This is not commentary. This is the literal mechanical reality of how monetary policy functions. Cutting the federal funds rate reduces the cost of borrowing, which stimulates spending, which pushes inflation higher, exactly the opposite of what the Fed needs right now. Holding rates steady or raising them slows economic activity further, which means more layoffs, higher unemployment, and a contracting labor market already losing 92,000 jobs in a single month. The Federal Reserve built its entire credibility around threading this needle. The February jobs data confirmed the needle is gone. The market reacted immediately and in a specific way that is important to understand. The S&P dropped over 1%, the Nasdaq 1.5%, the small cap Russell over 2%. Those numbers are significant, but they are not the important part. The important part is what happened to bond yields at the same time. Yields fell. In a normal market environment, weak jobs data leads investors to expect rate cuts from the Fed. That expectation drives bond prices higher and yields lower. On the surface, that is what happened. But the context tells a different story. When stocks and yields both sell off on weak jobs data, the bond market is not signaling rate cuts ahead. It is warning about economic deterioration. The bond market, which is historically the smarter money in the room, is not pricing in relief from the Fed. It is pricing in a deteriorating economy where the Fed is increasingly powerless. That regime shift in how markets read data is the thing to watch. The same report that 6 months ago would have sent markets higher on rate cut expectations instead sent everything lower simultaneously. That is a different regime. And recognizing when a regime has changed is the difference between positioning correctly and getting caught. Now add the consumer picture on top of the labor market picture. Retail sales already fell 0.2% in January, and consumer spending flatlined. This is before the February jobs data hit. The consumer was already pulling back before another 92,000 jobs disappeared. Americans have stopped spending while prices are still rising. That is the definition of a demand contraction inside an inflationary environment. Consumer spending represents approximately 70% of U.S. GDP. When spending flatlines and retail contracts, the downstream effects move through every sector of the economy. Inventory builds, manufacturing pulls back, hiring freezes, and eventually layoffs accelerate. The labor data does not lead the consumer. The consumer leads the labor data. Retail pulled back in January. Jobs broke in February. That is sequence, not coincidence. For 2 years, the official narrative from the Federal Reserve, from the Treasury Department, and from the financial media was the soft landing. The idea that inflation could be brought down without triggering a recession, that the labor market would cool gently, and that consumer spending would, moderate without collapsing. That narrative required every variable to move in the right direction at the right time. The soft landing the Fed spent 2 years promising is not delayed. It is dead. The February jobs report did not introduce risk. It confirmed a trajectory that was already in motion. 92,000 jobs against an expectation of plus 58,000. Unemployment at 4.4%. Wages still running at 4%. Retail contracting. Consumer spending stalled. Every single data point in that report points the same direction, and that direction has a name: stagflation. The Federal Reserve's next meeting will be one of the most consequential in years, not because they will make the right decision, but because every decision available to them now has a significant cost attached to it, and the market knows it. That is why stocks, bonds, and growth-sensitive assets all sold off together, not on fear of a single report, on recognition that the policy framework that governed markets for the last decade no longer applies. The jobs data alone would have been enough to anchor an entire week of financial coverage. But the jobs data did not land alone. It landed on the same morning that Brent crude broke $90 for the first time in 2 years, and a Qatar energy minister warned that oil could hit $150 within weeks. The inflation math the Fed is already losing just got significantly worse. And the reason why takes this story into an entirely different dimension, one that is no longer about economic cycles or monetary policy. It is about geography. It is about tankers. It is about a strait that carries 20% of the world's oil supply, and the forces gathering around it are not theoretical.